Hello and welcome to Between the Lines, the podcast that dives deep into the stories redefining Asia Pacific's reinsurance landscape. Normally, we record from our newsroom, but today we're recording from our homes as Typhoon Ragasa passes by Hong Kong. I'm Mithun Varkey, Editor-in-Chief of InsuranceAsia News, and in this episode, we'll discuss, of course, Typhoon Ragasa, which is lashing Hong Kong, Taiwan, and southern China, the recent policy address by Hong Kong Chief Executive and his plans for a marine risk pool in the city. We'll also discuss the Gen Z protests that are raging across Asia Pacific. We'll also talk about some of our recent stories, including Australia's plans for a flood pool, the flux in the W&I market, the insurance-linked securities market in the region, and Chinese insurers' newfound love for convertible bonds. We'll also bring you insights into the stories that the team is working on. And our special guest for this episode is TMGX underwriter Will Hiller, who joins us from Sydney. Hiller talks to us about the new Tokio Marine GX proposition, the renewable energy market, and the challenges to ensuring renewable energy risks in Australia's diverse and extreme climate.
But I do think that we're probably overdue a big event or a couple of big events to hit some renewable energy projects. I mean, we're expanding as a country the rollout of solar, wind, BESS at quite a rapid rate, so that the aggregation exposure is also increasing all the time. So it is quite difficult.
Today, I'm joined by Deputy Editor Andrew Mullen, Senior Correspondent Aidan Gregory, reporters Joana Nguyen, and Roshan Nambiar. Welcome, everyone. How's everybody doing with Typhoon?
Yeah, I've survived the panic buying. A local the other day asked me if we put masking tape up on windows in the UK, and the answer is not since the Blitz.
There's quite a lot to get through. Let's get cracking. Ragasa is turning out to be quite the typhoon. It's certainly one of the biggest I've seen in my nearly 10 years in Hong Kong. Certainly seems bigger than Typhoon Mangkhut, at least from my window. Andrew, can you tell us what's happening with Typhoon Ragasa?
Yeah, so we're right in the thick of what is the world's strongest storm so far this year. We're now at a Typhoon 10 signal in Hong Kong, which is the top scale for the system here. It's brought the city to a standstill here on Wednesday morning. That started on Tuesday, and it's going to go until at least the rest of today on Wednesday. From an insurance perspective, we already had reports from Bloomberg Intelligence that they expect $100 million of claims from this event. And to put that in perspective, Typhoon Hasso in 2017 was 138 million, and Typhoon Mangkhut in 2018 was 492 million. The South China Morning Post has also reported that there could be millions of dollars of costs for repairs and things, and this includes glass curtains and walls damaged by the storms. This is looking back to what happened during Typhoon Mangkhut as well. We're waiting to see, but yeah, it's definitely going to be a busy time for insurers.
Well, of course, one of the major disruptions has been flight cancellations, unprecedented suspension of flights from the Hong Kong International Airport. I'm sure quite a lot of people are stuck in Hong Kong. Quite a lot of events and conferences have been cancelled. In the past, the Hong Kong Stock Exchange used to stop trading once T8 was raised. They've changed that rule now, so the stock exchange is trading through T10. So the financial markets are very much open. There isn't a lot of disruption on that front, but I think all the supermarkets, the shops, everything has been shut. So that's going to have an impact on the broader economy.
The Hang Seng Index seems to be taking this typhoon in its stride. It's currently up 0.2%. as of about 10:30 this morning.
Talking about the Hong Kong insurance market, last week we saw Chief Executive John Lee in his policy address talk about some initiatives for the market here. He's announced a possible marine risk pool. Joana, you were following this story. Can you tell us a little bit more about the proposals?
Yes, so the marine risk pool is one of the most notable insurance-related policies announced by Chief Executive John Lee this year. It is to enhance the underwriting capacity for both local and mainland markets. It is part of government's effort to strengthen its high value-added maritime services. For example, like ship management, ship leasing, marine insurance, maritime law, and arbitration. One interesting fact is that vessels owned, managed, or operated by Hong Kong ship owners account for nearly 10% of the deadweight tonnage of the world's merchant fleet. So ships registered in Hong Kong are governed and protected by the local law. So their operations will drive the development of high value added maritime services.
Earlier this week, I was at a conference organized by the Confederation of Insurance Brokers of Hong Kong, and I had a quick chat on the sidelines with Clement Lau, who is the Executive Director for Policy and Legislation. Something that interesting that he mentioned as part of the chat was that the effort for Hong Kong, Hong Kong has been trying to build out itself as a risk management hub, and they've introduced policies for ILS and captives. But what Clement said, quite interesting, was that the way to grow the market here is to facilitate more business lines, bringing more underwriting into the market. And he thinks marine is potentially a big business line, considering the opportunity in the mainland market, which is one of the biggest shipping markets in the world. So he thinks that Hong Kong's got a unique advantage in building out a marine underwriting hub. The other big story that we've been tracking in the last couple of weeks has been the trend of protests across some of the South Asian countries recently. We had protests in Indonesia a month ago. This month we saw protests in Nepal. And what's interesting about these protests is these are the youngsters, the so-called Gen Z, who is protesting against the political system. So the latest report from the Nepal's insurance regulator puts losses related to the protests at around $150 million. That is a significant loss for a market like Nepal. A lot of these claims are coming from, we saw those pictures of newly built Hilton Kathmandu being burned down. There's going to be a lot of claims from that. We also, the Parliament building, the Supreme Court, as well as several government offices in Nepal were burned down. So there's going to be a significant amount of claims. And as I was telling you about the conference I was at earlier this week, I also had the opportunity to speak to some political violence and SRCC underwriters at the conference to suggest that this is sort of a growing trend across not just Asia and across countries around the world. What's really interesting about this is led by Gen Z. And a lot of these protests are, one of the underwriters was mentioning that a lot of these protests are planned online through TikTok and through other social media platforms, which the politicians or the bureaucrats are not necessarily monitoring. One common theme, and as we speak, there are protests happening in Manila. This is again protests against corruption, against the political elite, so to speak. One common theme across some of these protests, be it in Indonesian, Nepal or Manila, was a flag. This is a flag which is from a very popular Japanese manga called One Piece. Interestingly, all the protests, be it in Indonesia, be it in Nepal, be it in Manila, and some of the other protests around the world are using this flag, which seems to suggest that there is a lot of communication that's happening through the social media and trends that are spreading across markets, across countries. And what's interesting is that this points to the increasing frequency of SRCC losses. Somebody was mentioning SRCC is a bigger risk because of the rising frequency and the protection gap from an underwriting perspective than what potentially a war is, because a war, they're infrequent, they're large events, but they're infrequent. But the frequency of SRCC events is a cause of concern for political violence underwriters. In other stories, I think one big development this week has been the Everest Re's announcement of its entry into the Indian market. Aidan, you were on top of this. Can you tell us more?
So Everest Re has joined the growing list of reinsurers that have decided to set up shop in the Gujarat International Finance Tech City, also known as GIFT City, which is India's special economic zone in Gujarat. It's a pet project of India's Prime Minister Narendra Modi, and it's designed to, attract more international corporations to his home state. By setting up shop in this economic zone, companies are given sort of special privileges. It's also not regulated by the rest of India's regulators. The GIFT City has its own regulator known as the the Indian Financial Services Centres Authority, which just covers the special economic zone of Gift City. So Everest re-announced on Tuesday that it's opened an office in Gift City after receiving approval from the regulator. Everest Re is now the fifth insurer to open an office in the zone after Singapore Re, Berkeley InsuranceAsia, Peak Re, and Allianz Partners have all opened offices in Gift City recently.
Now, certainly the momentum seems to be growing for Gift City. We won't be surprised if we see more of these announcements coming in the next few days. Joanna, here to scoop on Marsh's Johannes Daniel Welzman moving to Gallagher. Tell us more.
Yeah, so it has been one of the most popular stories this week of our newsroom. So Marsh, head of corporate and commercial for Pacific Business, Johannes Daniel Welzman, is set to move to Gallagher in March, joining Alex Lumby, who will become Gallagher's Australia CEO. This is one of the latest executive moves among the Australian brokers. So, nearly all the top international brokers in Australia have new leaders in place. And it does seem that this exit has been overwhelmingly from Marsh. So this is something we aim to follow up on.
Sure, it'll be interesting to find out what's causing this churn in the market. And talking about shakeups and Australia, there was a National Climate Risk Assessment report that came out last week, which paints a scary picture of climate change and its impact in Australia. Obviously, that report was by the Albanese government. And soon after that, we saw an Australian delegation tour Europe to discuss reinsurance and insurance solutions for Australia's NatCat challenges. Andrew, you've been following those developments. Can you tell us a little bit more about what the trip meant and what the outcomes are?
Yeah, sure. Well, point of order, there were actually delegations from Australia and New Zealand in London at the same time together. The Australia delegation was headed by Daniel Molino, Assistant Treasurer and Minister for Financial Services. And while in London, he said the aim of the delegation from an Australian side was to better engage with the London market in the solutions it could create for Australia. And he was there with the CEO of the Insurance Council of Australia, Andrew Hall. One thing that stood out from the visit from the Australia side was the Finance Minister said he was looking at how the UK's flood re-scheme could be adopted to work to support policyholders in Australia. And yeah, this was at the same time, pretty much on the same day that the Australian government published its first natural climate risk assessment. And this said that Australia was facing more intense and extreme climate hazards because of climate change. And this would put 1.5 million people facing a severe threat from rising sea levels by 2050. On the New Zealand side, they said discussions in London focus on how global reinsurance cycles, climate change, and pressures on affordability and accessibility are reshaping New Zealand's insurance landscape. And for them, the key themes included the need for better modelling and clear communication on risks, the role of its alternative capital, and international lessons on balancing affordability, resilience, and regulation. And the Australia delegation also visited insurers, reinsurers in Zurich and Munich also for some additional meetings as well.
It's quite interesting. I mean, I should point out that Daniel Molino, who's the assistant treasurer, was also the person who led the flood inquiry, insurance inquiry in Australia. So clearly, insurance is front and center conversations in Australia around climate change and risk mitigation. Moving on from Australia, we've had a story on the nascent emerging cat bond market in Asia Pacific. Aidan, tell us more about your story on the ILS market.
Sure. So, I mean, over the past fortnight, I've been back in the weeds of my old beat, writing about capital markets, which has been quite fun. So, firstly, we've looked into the development of Asia's cat bond market, which is still very much in its infancy, especially compared to other regions, particularly the US. The US accounts for like an overwhelming majority of the risks in the cat bond market. I think it's something like over 70% of the outstanding bonds that are issued. The underlying risk is US, particularly Florida and wildfire. But there is a growing number of Asian insurers that have done cat bonds, and it's been identified by multiple regulators in the region as an important source of growth, particularly Hong Kong, which has pretty much just set up an ILS and cat bond regulatory regime from scratch since 2021. And Hong Kong's, trying to position itself as an ILS hub in Asia. And it does seem to be working, because we are seeing, a growing number of issuers use Hong Kong as the jurisdiction to set up their cat bond and ILS vehicles. So we've now seen cat bonds from companies like MS Amlin and Peak Re and Taiping Re. And, while it still is a tiny percentage of the global market, it is beginning to grow. And we've spoken to various related parties for this story who, were very much involved in the development of this market. And there is growing demand for, alternative sources of reinsurance protection, particularly given the elevated natural catastrophe environment that we are in. With $140 billion insured nat cat loss every year is now kind of the norm rather than the exception. So, lots of reinsurers and insurers are looking at other ways that they can source some retrocession, and the cat bond market is a good way for them to do that. And the market this year is due to have its biggest year ever for issuance. The run rate for global catastrophe bond issuance has already outstripped 2024's total, and we still have the final quarter of the year to go. So it's going to be a big year, and this capital market is really sort of beginning to kick on and mature into something quite meaningful as a way of raising financing.
Certainly, I think we're seeing that all over the world and in Asia. But just talking about capital markets, the other trend that you picked up on was the newfound love from mainland Chinese insurers for the convertible bonds instrument. You've been tracking some of the mega issuances from the region recently. Can you tell us a little bit more?
Sure. So, this is highly unusual. You don't typically see large cap investment grade insurers doing massive convertible bonds. The typical customers of the convertible bond market, high yield or growth companies who either don't have a credit rating or, have a low credit rating. Like, you don't need a credit rating to issue a convertible bond. And the instrument allows companies to borrow very, very cheaply versus straight debt in exchange for giving investors the option to convert their bonds into cheap shares if the share price goes above the premium. So it's highly unusual to see the likes of Ping An and China Pacific doing these debt instruments. But that's exactly what we've seen in recent months. And China Pacific came to the market earlier in September and raised $2 billion via a convertible bond, which is never done before. So it's very unusual, but it's fueled by the rate environment in Hong Kong, which has seen sustained higher interest rates in recent years. And also Hong Kong's listed equity market this year has been on fire. The Hang Seng Index is one of the best performing stock markets in the world in 2025, obviously fueled by Hong Kong's it's fueled by Hong Kong's economic recovery, which has, finally begun to gain some momentum this year. And while they've not done convertibles before, the logic for them doing it now is very strong. Both Ping An and China Pacific have raised, they've raised a very large quantum of capital at a negative yield. And it also allows them to get around quite strict rules for state-owned companies about the price that they can sell new shares, because when you issue a convertible, you're effectively you're selling dilution at a premium to the current share price, which for state-owned companies like China Pacific and Ping An is beneficial because it stops them from falling foul of strict rules that govern the price at which they can sell new stock.
Right. I think China Pacific said it used to proceed for internationalization of their business, and I think that makes perfect sense in this environment. It's not very clear if internationalization means they would be looking at deals, but I wouldn't be surprised if some of that money goes towards M&A.
It's part of a much broader boom in Hong Kong's equity capital markets this year, mainly driven by mainland Chinese companies coming to Hong Kong to raise money for international expansion. Hong Kong will very much likely finish 2025 as the top IPO exchange in the world, which is a crown that Hong Kong hasn't had for quite a few years now. But it's coming, but it's roaring back in 2025.
True. while the capital market's coming back, the M&A market hasn't really seen that sort of bounce back. That's reflecting in the insurance market as well. We had a story that last week about the W&I insurance market, which saw a massive influx of capacity in the past 2 years. Quite a lot of MGAs coming in the last 18 to 24 months. And that's sort of changed the dynamics in the market. And we had a story recently by Joana and Roshan. Tell us what's happening in the W&I market in the region.
Yeah, so Roshan and I got in touch with several brokers and underwriters. And one thing we found out is that W&I premiums are at all-time lows across most jurisdictions and sectors in the Asia Pacific. This is due to, like you said, the primary underwriting capacity and intense competition among insurers. However, what's concerning is that there's a recent surge in high payout claims. This trend, together with, lower premium rates, more flexible underwriting and fewer exclusions, is probably not sustainable, and it will put a lot of pressure on the profitability for insurers and their reinsurers. So it may result in a withdrawal of capacity from the market. So a challenge for W&I insurance providers going forward will be, managing claims, servicing excellence alongside continued client-friendly pricing and coverage.
How about demand for W&I insurance in the market? Roshan, you also spoke to some of your sources. What are they telling you?
Yes, so demand for W&I coverage in APAC is still anticipated to remain healthy, especially in markets like India, Japan, South Korea, China, and Southeast Asia, where the M&A activity is gradually recovering despite global headwinds and uncertainty. Particularly, demand will be growing in complex transaction structures involving public listed companies and take-privates, secondary transactions, and transactions involving alternative investment instruments. Sources also see demand not only for traditional W&I policies, but also for bespoke solutions, including tax liability coverage and synthetic warranties. So, as you can see, underwriters have to be quick and have to adapt and innovate in the face of the increasing nuances in deal making.
Let's talk about what we're working on this week. Aidan, what have you got for us?
I sat down with this, Matt Freire-Rees, Asian head this week, to discuss the Spanish reinsurers' push into Asia Pacific, which they've identified as, core growth opportunity for the firm. We discussed various things, including, the outlook for the reinsurance market in Asia ahead of CIRC in November, and their hiring plans and growth strategy particularly in China and India, which Matt Freire sees as being two extremely important markets for their future in the region.
That's interesting. We'll look forward to that story. Joanna, what's keeping you busy?
The 1/1 renewal is coming, and particularly in Indonesia. I also spoke about this last podcast. There may be potentially a merge of 3 state-owned reinsurers, National Re, Indonesia Re, and Tugu Re. So I've been in touch with Indonesia Re to have an interview with their president, director, and CEO, Mr. Benny Wawuruntu, so that we can have more insights on not only Indonesia Re's growth strategies, but also the broader reinsurance landscape in Indonesia. So let's see how this will go.
Great. Yeah. Indonesia's quite an interesting market with all the regulatory changes and the changes in the market as a whole. Roshan, what are you working on this week?
So as Asia Pacific powers up with massive investments in China, India, and emerging markets like Vietnam and Indonesia, the region's energy insurance sector is undergoing a rapid transformation right now. We're seeing insurers compete with long-term deals and coverage tailored for everything from traditional power plants to cutting-edge renewables like hydrogen and offshore wind. Globally, the premium rates are falling, safety is improving, and there's quite a clear shift towards cleaner, more sustainable energy, which is challenging insurers to balance innovation with financial resilience. I'll be looking into how these changes are reshaping risk, opportunity, and the future of power and energy insurance in Asia and beyond. I will be getting in contact with people in the industry over the next week and seeing how the story develops from there.
Sure, that's great. And on my end, I had a brief conversation with Lockton's new head of specialties for Asia. So I'm in touch with Lockton to see what their plans in the region are. Clearly, they have a new regional CEO, and it seems like they have very aggressive plans for growth in the region. So hopefully I should be able to have a story on laying out locked-in strategy for the region. It's quite an unusual meeting we've had today. Some good stories to work on. We'll continue to track the losses, the impact the winds had on the markets around the region. So there'll be a lot to report on. We've had an early start to this meeting today, so get back to work. Stay safe, folks.
Thanks, Mithun.
Thanks, Mithun.
Thank you, guys. Up next is a conversation with Will Hiller, underwriter from Tokio Marine GX, the Japanese carrier's new energy transition platform. TMGX was built on G-Cube, an MGA that was earlier owned by Tokio Marine, and Will has been with G-Cube for a few years underwriting renewable energy projects in Australia. In this really interesting conversation, we talk about the new proposition that Tokio Marine brings to renewable energy companies in the region, as well as the broader challenges facing renewable energy underwriters in the region from the increasing frequency and severity of cat events. Listen in. Today we're joined by Will Hiller from TMGX, or Tokio Marine GX. Will, welcome to Between the Lines, and thank you very much for joining us. It's quite a blustery morning in Hong Kong, but I hope it's more pleasant than down in Sydney.
Thanks, Mithun. Good to be speaking with you. And yeah, it is slightly more pleasant weather in Sydney today, I think. So GX is a new underwriting platform that we launched back in May. It's become fully operational just a few weeks ago, and ultimately it's been built to help with the energy transition. So it's not coming from scratch as such. It's being built around the existing G-Cube business and the 25 years of underwriting experience that we have focused on renewable energy risks. But this is more of an expanding our appetite, expanding our underwriting capacity. We're putting out up to $500 million USD per project for our share. And yeah, ultimately, this is really just the intention is to help our clients through the decarbonization process and the green transition.
Right. So, I mean, GQ was always focused on as renewable energy underwriter. But do things change with TMGX? And I know, for example, in Asia Pacific, GQ was primarily focused in Australia. Now, given that you've rebranded and you have a bigger platform, so to speak, in APAC, certainly, do you think there is a sort of, you'll be writing more risk across more regions around APAC? And in terms of the kind of risks that you write as well, do you think there will be changes around TMGX?
Yeah, absolutely. I think, particularly as we're drawing on the expertise in the wider Tokio Marine Group, which obviously has a huge presence in the Asian market, I think, there'll be more opportunities for us to build out our business and expand into Asia. We already do a bit of business in Asia, but this will provide the opportunity for, I think, further expansion. And in terms of the historical GQ business that we've written primarily on renewable energy projects, so wind, solar, BESS as well, we will be expanding into some other types of technologies and product lines. But again, drawing on the in-house experience that we have within the wider Tokio Marine Group.
I mean, you've been in Australia, especially GQ, for a few years now. And Australia, as we know, is really the front end of that energy transition and the need for it as well. I mean, in light of the recent NCRA report from Australia, there's quite a lot of focus on that, the government and among businesses. How does Australia's sort of diverse climate risk profile impact the underwriting process for renewable energy projects across Australia?
I would say Australia doesn't just have an extreme climate. It's got an extremely diverse climate. We're a big country with lots of different regions. Depending on the specific area that we're talking about, there's cyclone, windstorm exposures. We're seeing increasing lightning storms and severe thunderstorms, hail risk, bushfire, around sort of most of the country. But depending on the season, we've got increasing floods that we're seeing, and just heavy rainfall as well can cause some pretty significant issues. I suppose to add to that as well, the weather patterns we're seeing are intensifying as well. We're seeing records being broken almost weekly. And I think importantly, from an underwriting perspective, we need to really focus on a tailored approach rather than a one size fits all, putting the whole of Australia into one bucket.
Well, very often you see this with this bushfire and there's the cyclone and the sort of seasons sometimes overlap as well. And then between you have, SCS events, quite a few in the past few years. So the projects in the same region is exposed to different varieties of events, like you were mentioning, and there's a growing frequency of it. How do you sort of price for this risk, and how do you sort of tailor your policies to manage these risks?
Well, that's a very good question. It is becoming increasingly more difficult to predict where these events are happening. As you mentioned, we're seeing, increasing frequency and severity, but not only that, we're also seeing NatCat and weather-related events happening in areas that I think most people didn't expect. When we look at the models, they're low exposed areas. We're seeing events happening more often in those types of regions. So it is very difficult to underwrite to these types of events. It's incredibly volatile. Some years can be quite good. I think, in terms of renewable energy risks, the last couple of years have been okay. I think we've been relatively unscathed if you compare us as an industry to other parts around the world. But I do think that we're probably overdue a big event or a couple of big events to hit some renewable energy projects. I mean, we're expanding as a country a rollout of projects, solar, wind, BESS, at quite a rapid rate. So that the aggregation exposure is also increasing all the time. So it is quite difficult. And I think if you asked any underwriter that's writing renewable energy risks in Australia, what's your biggest concern? I think most people would say natural catastrophe, included in that weather-related events, heavy rainfall and things like that.
I mean, in terms of perils that impact, and you mentioned that, unusual events like we saw with the tropical cyclone Alfred, which hit as far south as Brisbane, which is quite unusual. NatCat is the big risk, but are there any specific kinds of perils that you're more worried about than the others? I mean, solar, for example, SCS events, hail events have been a big theme. We saw, for example, in Japan last year, there was quite a lot of losses around that. Are there sort of specific trends that you're seeing with some of these perils that are particularly affecting renewable energy?
I think, there's all sorts of different perils that do need to be considered. But if I was to pick one in Australia, I would say hail on solar farms is probably the biggest risk for us. We've seen one large event that happened in southeast Queensland a couple of years ago. Mm-hmm. We haven't had any since, but like I said before, we have been as a country building a lot of solar farms around the eastern seaboard, in particular, where that hail exposure is worse than other parts of the country. And I think there probably is a common misconception that it's only Texas that gets hailstorms.
Right.
You could argue that the exposure there is much worse, but that's not to say that there isn't any exposure in Australia. We've seen it happen before. It will happen again. We just don't know when or where. And
how do you sort of, one of the things about renewable energy when we speak to underwriters, obviously, is the sort of new technology, the fast pace of technology disruption happening within the renewable energy space. Solar and wind has been around for a while, but BESS, as you mentioned, battery energy storage systems, it's a fairly new sort of technology that's growing rapidly. This talks about hydrogen and other kinds of new renewable energy fuels. How do you keep up with these emerging technologies, and how do you sort of assess the risks around these new technologies?
It can be difficult at times because the industry is moving, at quite a rapid speed. I mean, in terms of BESS, as you mentioned before, there really wasn't a huge amount of it in Australia up until a year or two ago. That's not to say that technology hasn't been around for a considerable amount of time, but in terms of the size of the projects that are being built, the uses of those particular projects, what they're being used for to assist with the grid, is new. And then, I mean, looking on the wind side, the turbines are just getting bigger. We're seeing a lot of differences in the technology as they are getting bigger as well. Part of those turbines being redesigned, lightning protection systems, for example, we've seen that cause us problems in the past, where the lightning protection system has worked perfectly fine, but because the turbine's a lot bigger and has a different design, they've had to redesign the lightning protection system, which hasn't been as effective in stopping lightning losses. I would say on the solar side as well, we mentioned hail before, that is a big concern, and we are seeing some innovation, which I think is quite positive on that side of things. We're seeing higher angles of stowage for panels and trackers, meaning that that they can avoid direct impact from hailstones. You have faster response times, in terms of getting those panels into the appropriate stowage position, and then also smarter monitoring, keeping more on top of the weather on the day as it changes. But what I guess I would say about that is it's still not perfect. It does work, and it has proven to work in many cases. But at the same time, we've seen situations where that technology hasn't worked, for various different reasons. It could be because the defense stowage system wasn't online at that time. Maybe it was, still in the construction period, but the panels have been installed. There's all sorts of different reasons why it might not work. Sometimes a hailstorm can just come out of nowhere. So it's unpredictable and very difficult. And also, if you have to contend with different stow angles for wind and for hail, some of the manufacturers, choose the same, some choose different, and that can lead to problems if you have to decide, in the middle of a storm, do we put it in wind stow or hail stow?
So it could lead to different outcomes, and it seems to be a trend around the world. I mean, I think in the US as well, these continue to be a big challenge. I just want to ask you about sort of how does data and analytics, and how do you sort of use that in modeling and pricing this evolving risks? Now, I mean, especially with the backing of Tokio Marine, which gives you, I would imagine, quite a lot more data and access to information. And modeling software, etc. How is that helping your business, and how do you see that evolving in your sector?
Yeah, I think we've been collecting data for a long time. G-Cube had operated for over 25 years, insuring renewable energy projects, and over this time we've obviously captured quite a lot of data, which we do use. I think the more data that we can get, the better. And like you mentioned, drawing on data from the Tokio Marine group as well has just added to that. I would say, however, that I think the data can only take you so far. Mm-hmm. You can use it to try and help predict things, but at the same time, what is probably equally as important, or potentially more important, is adequate risk management and the right attitude from the insured in trying to mitigate those risks.
Right. I mean, if I may ask, how's sort of the competitive landscape for renewable energy underwriting around the region? We have everybody I speak to certainly in APAC, seem to be big on renewable. And is there a lot of capacity? I mean, you with TMGX, you're putting out pretty big lines out there as well. Are you seeing more capacity, more competition, more? Is it a more challenging environment?
Yes, yeah, absolutely. It is becoming more challenging, more competitive, and I think that what this really highlights is the long-term approach. And I think what's key is that developers and owners of renewable energy projects are looking at the long term. While it may be slightly easier to get insurance capacity at the moment, these projects are being built to last 25, 30 plus years. And, as we all know, the insurance cycle continues moving along. And in some years, it may be more difficult to get insurance capacity. So I think taking that long-term approach it is really important to make sure that, there's a focus on 25, 30 years of insurability rather than, just the construction and first year ops. At the same time, I think it's important for insurers also to take that same approach. We can't just look at things on a year by year basis. If we want to be able to offer sustainable capacity for the long term, then I think it's important that we act in a way that we can protect our capacity and continue to offer, sustainable, stable capacity for the foreseeable future.
Right. And in terms of the products out there, is there, quite a lot of conversations around things like parametrics and looking beyond, so some innovation around the kind of products that are available out there. Is TMGX offering sort of new sort of products? Do you think there is demand from the market for new products in this? Is it a question of the insurers trying to push some of these products, or is the market asking for new innovation from insurers?
Yeah, I think it's really being driven by our clients' needs. Yeah, we've had to expand into different areas to help our clients. Obviously, going through the transition, decarbonizing is not as simple as it sounds. It's, there's a lot of complexities to that. And with those complexities, there are insurance requirements. So yeah, we're looking to address our clients' concerns and offer them products that they need in order to be able to go through the process of decarbonizing.
Great. That's all the questions I have for you. Well, thank you very much. And indeed, it's a question of managing the complexities of decarbonization and the energy transition. And certainly in Australia, after the National Climate Risk Assessment reports come out, I think that does paint a bleak picture. And it's clear that we need more renewable energy, more investment into energy transition. So great. It was wonderful talking to you, Will, and thank you very much for your time.
Thanks, Mithun. Really great to speak to you.
That's all from us in this episode of Between the Lines. We'll be back again in 2 weeks. In the meantime, you can connect with us on LinkedIn. Make sure you're subscribed to our daily and weekly newsletters delivered straight to your inbox. And of course, we'd love to hear your feedback on the podcast. Email us at editorial@insuranceasianews.com. I'm Mithun Varkey. Thanks for listening.